And now, let me introduce to you our next speaker. Let's welcome our Chief Technical Analyst, Mr. Juanis G. Barredo.
All right, good morning, everybody. Thank you for visiting us today in a very different venue. Now, when I come to be able to explain to you what happened on the technical front for the market, clearly we're coming from a year that was clearly not a very good one. And in our ability to understand what this recovery that we're seeing is all about, we have to understand also what happened last year. So if you look at the performance of many of those markets that we're looking at over here, we look at big declines coming off from pretty much across the world, with China leading it down over 20%. And many of these declines that we saw during the period started back in February. So if you had a major sell-off taking place, that's a lot of selling that took place in those last so many months of the year. And we started 2019 on clearly very different footing. We had a lot of negatives. I think the speakers earlier on were talking about higher inflation, the rise in rates. All this contributed to that massive sell-off that we were looking at. So far, it seems that all those bad news we've seen so far is over. And it's because of that the market took light of that condition and decided to make a recovery run for 2019. Now, in our ability to move forward, you can see in the chart of the Philippine Stock Exchange Index here that there's been quite a bit of a rally already. I think April mentioned, I think up to date is already coming closer to about maybe 17 to 18%. And there's a big rally, and you can clearly see from the bottom we see sometime mid-November all the way up to where we have there. Now this recovery swing that we have, she says, might be capped, and I would agree with it. And the reason for it is you're not going to go from zero all the way up to so quickly in just a short period of time. And so I think in the first half you'll get a lot of this volatility also coming back after this rally is done. The question is, where? And so the rally that we've been seeing has climbed up closer to about 8,053 so far, but the potential for this to be able to move even further, I'm looking at a maximum immediate target of about 8,200 to 8,300. To struggle above that in the very, very short term might be very difficult for the market. We can look a little higher later on. But for now, I think the market is already starting to struggle. I can see some evidence of some issues starting to show some momentum strain. And because of that you're going to have to be prepared. You're going to see some stocks start to pull back a little bit or consolidate. There will be the weaker ones, which may have to draw down a little bit. But there might be rotational swings, which means that you'll see some issues take over now, those that probably didn't move yet, or those that have wound up to be able to continue forth. This would be a market that traders will like. And the reason for that, there will be a lot of volatility, as I said, and that will carry a lot of trading opportunities for those who are watching into the short term. In that particular light, I think the only thing we really have to make an assessment is what's our risk on the downside. Because I think April mentioned earlier, the big question is, this is where the market is today, what am I going to do right now? If I'm in the market, that's fine. At least you've got a position, you can hang on to it and see what potential targets there are. But what happens if you're not in the market yet? If you're not in the market yet, that might be a little bit more hard a decision for you because your risk reward from here is a little hard to make up. Your upsides will be, let's say, 8.2 to 8.3. Your initial downsides could be maybe back down to about 7.7. Not so bad because it's about 50-50. But if the downside attempt to widen, then of course that's something that we're going to have to be able to protect ourselves with. Now, I feel confident that we've seen the worst in terms of what the index had pulled back to. And when we say that meaning the worst, meaning if this index attempts to come back down again, it would likely not break that low we've seen before or that one we've seen recently. You see the picture I have here, there's a very big price channel you have. Every time it hits that blue line, it seems to have restored itself and recovered. And that also contributes to the fact that there seems to be heavy support in the market at this area. Now my concern is that we've seen quite a bit of a rally, and into that particular rally it's been quite a stretch. I hope that all the corrective effort that we've seen so far is necessary built into that price. But this stretch is something we're going to have to be able to make a clear assessment of when it begins. Now, of this particular condition, if you can see this blue line that I've drawn so far in that chart, that is a 200-day moving average. If I can just point to it with this. I'm talking about this line right here. Okay, so we're going to be watching that line on occasion today because that's an important threshold for us, and I feel markets should try to stand above that if it continues to be able to show strength. Now, a good scenario for me would be an index that would only pull back at a very limited scope. For example, the picture you have here is a gradual pullback, wind up of the market, just to try to release some of the stretch we've seen in the short term and allow it to be able to carry forward. Now, to be able to move forward, you can see this. Now, this is a possibility. What happens if the market decides to pull back a little heavier than that little good scenario? I call this a sad scenario because it's going to be a little tricky to handle. Because it could pull back, it could consolidate, and then boom, have one more hiccup just before the rally comes. I've seen this happen quite a number of times, and that's the reason why it's essential that we have to be prepared just in case these things take place. So the way I would like to look at it is if the market is showing that the worst is over, and there could be potential reactions that could beset our market into the short term, then the position we should be taking is, all right, then what will be the entry points that I should use to get into this market? Okay? So by reviewing those particular situations and giving you a sense of that, that should be able to allow you to be able to prepare yourself. So on a maximum, you could see a drawdown, maybe back down to what we call a 61.8% pullback from this rally that you've seen from November to January. Now, unfortunately, there's one more scenario. The ugly one. But let's look at things on the optimistic side. If this happens to come out, and I will bring a very small chance of this doing so, all it's going to do at the maximum is maybe come back down to where we saw a major low, gradually turn itself around, and eventually rally again. There will be no new low. Okay? Now, my perspective is I'm going to stick with the more positive reading, but just in case, all right? Just in case it happens, we have to know what the thresholds are, that we know that something like this may be coming before us so that we can prepare. Now, this is a picture of that index I showed you earlier on, and this is where we are today. The purple box you see up there, that's where your index is. And with the target I showed you earlier between about 8,200, 8,300, that'd be closer to where the top end of that violet box is, or where I actually drew in a 61.8 Fibonacci rally. If it hits that area and it starts to struggle and the market starts coming down, then we're going to have to be able to put on our defensive suits and try to see how to be able to manage through this, because this is a potential worry. If that 200-day exponential moving average breaks, it's quite possible we could see this. This was a situation that had happened right before the year 2000. This was a year back in about 99 to the year 2000. That index looks quite similar to what I'm seeing today. And what happened there is that the index fell all the way back down after it broke through that moving average. So that 200-day moving average to me would be quite key. That's an exponential moving average that we use. And so I will track you, and just in case I see such critical points happen, I will alert you in many of the writings that I attempt to do for you. So we'll just be very careful of that. Now, what's the likelihood of these scenarios taking place? Oops, sorry. I think I will put higher credence or possibility for the first two, which is either a good and sad condition, and that's why I'm going to prep you for that type of environment. The other one, maybe a 15% scenario. It could probably only come in when something more surprising happens, or let's say something external influences the Philippines and that we're going to have to make an adjustment. But for now, we're going to concentrate on how do I get back in case those good or sad moments do come in. So this is the kind of position that I would want to be able to look at. You will get markets that will come back and they will seesaw up and down. You now plot them out with the usual moving averages that we've been talking about, normally a 50 or 100-day, pullbacks to that, rebound from there, you buy it. And as long as we are in recovery mode, nothing untoward should happen to you. And as we know too, if it does fall below those areas that we've highlighted as support, then we know what to do. We have risk measuring capacities to be able to stay on the not so aggressive side in case they happen. So look at the image that you see there. Pullbacks to those moving averages are waiting for opportunities for us to get in. And as long as the uptrend maintains itself and this recovery is in store, we just continue to do that over and over again. In case a scarier scenario comes out, which is the sad scenario, you might see prices fall all the way to a 50% or 61.8 Fibonacci retracement zone. I just drew the zones there. 50% means it retraces half of the rally it made. 60%, maybe 60% of the rally that it made. That's all it means. Normally, when markets fall to those areas, they show good levels of support and they normally make comebacks. So for some of you who have not been able to buy the market yet, and medyo nakakatina naman mga daliri ninyo, you probably want to wait just a little bit longer for these opportunities to come back inside. Right? Don't just be too aggressive. Our risk reward from where we are is a little stunted. And that's why we have to be able to buy markets off a reaction rather than on very, very aggressive momentum runs. We're not in that type of market today. Here's an example of DNL, just to show you what a good scenario would look like. So this was an example a few years ago. And you can see in DNL, again, pullbacks to those moving averages. That's what I pointed out. And all I did was draw a little dotted red line to tell me the correction is still taking place. And the minute the price elevates itself off that red line, you buy it. And in this particular case, you roughly have three situations, three lines that have been broken. And on those three cases, you can enter during those particular things. Now, majority of these techniques are usually for traders. If you are a long-term investor, as long as the recovery is in place, no need for you to sell. You just go ahead and sit it out. Unless something major warrants a major sell-off, and that's the only time that maybe you want to handle some profit taking. In the sad scenario, I spotted this in Ayala Land. And if you notice, this is exactly the situation I did. Look at it. Pulled back, did a little ABC Elliott correction, fell back to your 61.8 retracement, and after that, the stock managed to be able to recover. So I will try to guide you as every time I see these patterns, I will feature them in the tech spotlight so some of you guys can have a look at them. So do keep abreast with some of the research reports that we do write so that we can get you much closer to those entry and exit periods. So the other factors that you probably also want to know about, okay, how is the US going to affect us? What's going on with the dollar and the peso? And how oil price is doing? Because I think April mentioned that because of the fallback in oil prices, that certain things have changed since what we've been seeing early December. So the US market is in a recovery condition. It is in a downtrend rally. And a downtrend rally means for the meantime, we're seeing a recovery, but the downtrend is still intact. And nothing suggests to me that that's over. In fact, we're already reaching towards an area that I would anticipate some resistance to come in, and because of that, I think some choppiness is getting ready to come back for the Dow, the S&P, and even the NASDAQ. Resistance is closer to about 2697, and we're quite near to where that line is right now. Just in case it breaks it, it might even rally all the way up to where that horizontal red line is, but I feel that's already a stretch. This needs to be able to pull back and tell us whether it solidifies or not. The only way that's going to happen is this has to come back down, make a higher low, and then establish a new and more firm trend. We're not there yet. This has not even double tested its support yet, and normally for a very strong reversal, you have to see that. So there's a possibility the rally in the US could stall. And if that were to stall and pull back, what do you think is going to happen to other markets? So be ready for that. The US dollar, I think our Professor Kitney earlier was talking about what potentially the dollar could turn around, but there are so many variables that could influence it. Looking into the technical side, the rally on the dollar is still actually maintained. It's been holding itself above the 200-day moving average, which is that blue line you see on the lower end. And drawing an uptrend line of that, we have no violation of that support as of yet. So the only thing that will worry me in this rally that we're seeing right now in the dollar is if the rally stops before the midpoint and starts turning back down to the lower end. If that were to happen, that would suggest to me that more weakness is coming to the dollar. Now, why do I need to look at this? Well, this might eventually influence this, which is our Peso-Dollar Rate. And The peso-dollar rate, as you can see it so far, is maintaining its depreciating trend upwards. This is the peso-dollar rate. And you can see that the moving averages still suggest that there is quite a number of support levels pushing it into that particular trend. We've not seen any turnaround in that effect just yet. So the high side of that band would be somewhere closer to about 54 pesos. I think it might be tough for prices to go above there. And right now, support's at 52. If that were to break, then maybe it can strengthen back to about 51, but I'm not looking at anything beyond that point. But 52 should probably try to keep prices stable. So your range will still be 52 to about 54. And looking into oil prices, the reason why everybody was worried about the movement last year was really an inflation-driven situation. Oil dropping down helped a lot because obviously that would have curtailed a lot of the costs that would have come to quite a number of industries. But oil is in a recovery right now. I think it's hit its bottom. And with oil hitting a bottom and we're seeing a recovery, the pullback on the upside should be maybe a range of about $55 to maybe even $59. I think at those ranges, it'll get stuck and pull back and probably try to consolidate. If a recessive environment takes place, then there's no worry about oil going way too high anyway. So more likely, you'll probably see continuing pressure into oil into the short to medium term. So I'm not looking at anything grand on the upside. I think oil should play ball and stay relatively where it is, maybe just bounce around within a set boundary. All right, so in summary of that, again, we've seen a sell-off in 2018. That means the market emptied its selling coffers. The rally you're seeing today is stemming from that particular removal of shares. Your market is now making a recovery. I think we'll probably, in the immediate period, maybe we'll get 8.2 to 8.3 being a stopping point. I hope later on, towards midpoint of the year, that we could rise all the way to what I think April suggested, closer to 8.6. But I think, was that a year-end target? That was a year-end target for her. I looked at the technicals. There is the evidence that that could possibly be a target as well because the recovery could also stretch into that capacity. But like I said, in the short term, maybe not so strong there. Now, these advances that we're seeing are going to go through a corrective period, and I think rotation will come in. So a lot of you, you're going to, if you guys be watching the market every day, you're going to see some moving, some pulling back, some going sideways. You're going to be scratching your head. Ano bang gagawin ko dito? Ano bang pipiliin ko? When you more likely pick the one going up, it will stop, and then next one, the one that's not moving, is the one you're thinking about, and you're going to do a lot of switching. So I know that's going to be tough, but that's what traders like. And to the long-term investor, you might want to close your eyes for a while, right? And just mark off, all right, as long as prices stay above the levels I said, you can hold. If things look a little bit more dicey and they crack essential support, put your thinking cap back on and say, ano bang gagawin ko dito? Siguro by that time, traders would have jumped out already. So you might want to be able to be a bit more abreast with that. But there will be a lot of opportunities. So please, the traders, watch for new setups, look for those supportive areas I pointed out. You should be able to get your recoveries from them. The risks, yes, there is. US, I think, may be still a risk. We may have weakness in, like I said, we'll watch the dollar and the peso to see if anything will come out of there. And oil prices, okay, maybe a little bit more of risk if a recovery comes in, but I don't think it's going to be too heavy. The biggest risk I feel will probably come from the US. Finally, I think stock selectivity is going to be the flavor of the next 6 months. And that means that you're going to have to really work at it to be able to point out which ones will probably be more prime movers, and some, I'm sure, you will have to have more lagging type of indicators as well. So just be prepared for that. Now, in the conditions, I looked at some of the stocks April pointed out to you, and we looked at some of the technical conditions in this grid that you have. And this particular condition shows that there's a lot of movements that prices have. If you notice on the first column, the stock code, and in the middle columns, I drew up the exponential moving averages, the 50, 100, and 200 day. If you see the color is red, that means that the distance from the price to that moving average is greater than a certain threshold. The thresholds I've written in the bottom of the columns. So in the first one, on the 50-day, If it's red, that means the distance from the current price to that moving average is 5% or more. In the second column, it's greater than 7%, and in the third column, it's greater than 9%. Now, I did that so you can evaluate how risky it is for you to buy it now. More likely, that means the stock price just took off and is now so far away from its short, medium, or long-term support. And if it's too far away or the distance is just too risky, you really might want to wait for prices to pull back. Right? So at least you have a cheat guide to be able to handle that a little better. The green one is only one right arrow, which is China Bank, and that means the difference from its current price to that moving average is actually on a positive note because China Bank has actually fallen down quite a bit, and we do have a few slides into that. Okay, just very quickly, I'll go through some of these slides just so you can see the rest, and then you can always ask me these questions during the Q&A. But let's just do it very quickly. Metrobank. Metrobank actually is into a recovery swing, and if you can see, the channel is very much still in place. I'm worried a little bit about momentum, so where it is, maybe it might climb a little bit more, but I feel you're going to start seeing some struggle in Metrobank. So you might want to take a little profits and buy back in the lower end of the channel. Security Bank is pretty much the same, not as strong, but still also moving up into an upward channel. Resistance, I would expect between 183 to about 190. And pullbacks to support, maybe you want to look at it closer to about 168, maybe 165. DNL, a little too sharp for my blood. Prices had gone up, it's quite overbought. If you look at the bigger channel that I drew inside there, that it's already hit the top end of it, it might really need to pull back. So I'm more in the profit-taking camp and wait for a potential buyback. I do like the formation this on the big picture, so look to be able to buy this back once it settles down. Maxes. Maxes also moving into a channel. We notice the patterns are kind of the same. That's good, makes my job easier because it's just the same thing over and over again. And the lines that you draw will tell you where your next buy range may be closer to 12, maybe about closer to 1150. Okay, here I'm a little worried. Now, SSI pulled back quite a bit, and it's now dropped into a consolidating pattern at a very critical junction of support. If that support breaks, which is a support closer to about 230, if that breaks, we're going to get quite a bit of a decline. So just be careful there. I do hope a breakout comes in rather than a slide down. Bloomberry, I think in the short term, it may have hit some targets. You might want to already start some profit-taking sessions here and look for potential buybacks at support. That's between 992 and 937. Ayala Corporation, very wide trading range. This guy's been famous for placing out quite a number of shares and did it again just not too long ago, and because of that, prices fell sharply. Normally, after a shell shock like that, it takes time for prices to be able to come back. So it may have to go to a new period of accumulation. I think the area pattern will continue. Ayala Land has two channels to be able to look at. We're also coming closer to the high band of that. So if you have it, you might want to hang on a little bit more, but me, I'll be looking to take a little bit of some profit. The MACD is already not looking very nice, so I would be taking some profits even as early as right now. Buybacks may be closer to about 41.80, maybe 40.80. Megaworld, top end or low end? Top, okay, you can read it as easy as I am. Maybe one day I'll just give you all the lines and then you can interpret it very quickly. So again, take some profit, but the very big picture of Megaworld broke out of the very big pattern, right? So don't keep your eye off this stock. When this comes back down to support, you want to be able to try to get some of this into your portfolio. This looks quite nice. Cebu Air, also moving back up. I'm quite surprised that even with oil prices running, that we're still getting a rally from this. But I think it's because Cebu Air has been bashed for quite a number of months right now, and it's just finishing off its recovery run. My suggestion, don't wait for the top anymore. This stock is hard to sell when it starts correcting. All right? So if you want to do this, you want to start liquidating this on the way up. So we'll try to be able to understand that there's certain illiquid conditions you have, but support for this could be quite a bit where that blue line is, which is closer to almost 80. China Bank is trying to make a reversal pattern. This is called a rounding bottom. At least I want it to become a rounding bottom. And if we do get a break over 28 pesos, then then we'll probably see something more steadfast on the way up. But you notice it's having a hard time. I feel there's a seller out there who's locking the price in, and now the battle between the guy accumulating and the guy selling is taking place. Let's wait who the winner is. All you have to do is wait for 28 to break, and then you can go ahead and jump in the joyride. MPI, again, this is another company that has heavier shares. Wait for prices to be able to go to the bands before you move in and out. Right now, the lower end of that range is closer to about 482 to 472. Top end of that range is 525. If it breaks that, it'll quickly go to about 550. First holdings, too high or too low? Okay, I'll move on. First gen, pwede, hindi pwede? Pwede. Okay. All right, remember, wait for the pullbacks to moving averages, and if it spikes up and it breaks a red line, then you can come out to get in. Right now, MACD is still telling me correction is not finished, so we just wait a little longer to make sure that we don't just jump in too early. I think there should be a little bit more corrective time here. Okay, so with that, I bring the wrap up. Do ask us the questions later when we have the panel. And just before I don't see you again, Kong Hai Fat Choi, Happy New Year to the rest of you. Thank you very much.